Why do the rich keep getting richer? What are some investments they avoid at all costs? Welcome to our journey into the world of wealth secrets, where we uncover the investments that the rich typically steer clear from. In this captivating exploration, we'll delve into the strategies that wealthy individuals use to safeguard and increase their fortunes. We'll discuss various types of investments. With each step, we'll reveal why these investments might not be as appealing as they first appear. First off, unproven startups, risky, unpredictable, and often a gamble. Now, why would anyone shy away from a potential gold mine? Well, the key word here is potential. It's an enticing word, isn't it? Like a treasure map promising riches, but often leading to nothing more than a mirage. Startups are similar. They're fraught with unpredictability and a remarkably high failure rate. It's a fact that 9 out of 10 startups don't even make it past their first 5 years. That's a stark reminder of the volatility in the startup world. So it's not surprising that the wealthy are cautious. Yes, the idea of investing in the next big thing is exciting, but the rich recognize the importance of due diligence. They realize that a sound investment strategy is built on more than just hope and potential. In essence, the rich prefer to invest in proven businesses with a track record of success. Next, private loans without collateral, high risk, low reward. Picture a scenario where you loan a friend a hefty sum with nothing but their promise to pay you back. Sounds risky, right? That's because it is. This is the world of unsecured loans, a realm of high risk and low reward. The danger is in the potential for default. Without any collateral, there's nothing to fall back on if the borrower fails to repay. It's like venturing into the wilderness without a compass or a map. You're left exposed, vulnerable, and the chances of a safe return are slim. Now contrast this with loans backed by collateral. Here the lender has a safety net. If the borrower defaults, the lender can seize the collateral to recoup their loss. It's a more secure option, a safer bet. The wealthy understand this. They know the importance of security in their investments. Fixed annuities with low returns, slow growth, limited potential. When we talk about fixed annuities, we're referring to a type of investment that provides a guaranteed rate of return. But here's the catch. This rate is often quite low. Now you might be thinking, well, at least it's a sure thing, right? And yes, that's true. But consider this. While your money is slowly growing in a fixed annuity, there are countless other investment opportunities out there that could potentially offer much higher returns. What's more, fixed annuities often come with long-term contracts, sometimes even for life. This means your money is tied up and not readily available for you to seize other, potentially more lucrative investment opportunities as they arise. This is why the wealthy tend to steer clear of fixed annuities with low returns. They understand the importance of flexibility and high growth potential in their investments. Lottery tickets and gambling. High stakes, low odds. It's a tantalizing prospect, isn't it? The thrill of the game, the glimmer of hope that you might just hit the jackpot. But let's look at the facts. The odds of winning are astronomically low. You're more likely to get struck by lightning than to win the lottery. And gambling? It's a game of chance, not skill. You're essentially betting against the house, and as the old saying goes, the house always wins. Now let's think about this from the perspective of the wealthy. They didn't amass their fortunes by relying on luck. They did so through calculated risks, strategic investments, and a whole lot of hard work. They prefer to have control over their money and where it goes. They understand that the key to growing wealth is not about playing games of chance, but about making informed decisions. I hope you're enjoying the video. Please like and subscribe for more financial freedom tips. Uninsured investment properties, high risk, potential for total loss. Now imagine pouring your hard-earned money into a property only to wake up one day to news of a fire, flood, or other disaster that destroys it. Without insurance, your investment could go up in smoke, literally. Insurance is not just a safety net, it's a shield. It protects your investment from the unexpected. It's not about pessimism, it's about pragmatism. Disasters can strike at any time. When they do, insurance can be the difference between losing everything and rebuilding. Risk management is not an option, it's a necessity. It's about making smart choices to protect your investments. And that's exactly what the wealthy do. They don't gamble with their assets, they safeguard them. They understand the value of insurance in mitigating risks and protecting their wealth. So, when it comes to uninsured investment properties, the rich steer clear. They prioritize insuring their investments to minimize potential losses. Timeshares. Limited use, high costs. Timeshares, in theory, sound like a dream come true. A vacation property you can use for a portion of the year without bearing the full cost of ownership. But here's the reality. Timeshares come with significant limitations. Firstly, you're typically locked into a specific location and time of year. Want to switch things up and go somewhere else? You might find it's not that simple. Secondly, timeshares can be a financial drain. Aside from the initial purchase price, you're also on the hook for yearly maintenance fees. These costs can rise unpredictably over time, and you're obliged to pay them whether you use your timeshare or not. Lastly, selling a timeshare can be a real challenge. The resale market is often oversaturated, meaning you could lose a substantial portion of your initial investment. So, while timeshares might seem attractive at first glance, they lack the flexibility and control that savvy investors crave. Penny stocks, high risk, low liquidity. They're enticing, aren't they? The idea of buying stocks for mere pennies and potentially selling them for a substantial profit. It's the allure of the underdog story. But let's uncover the reality behind the glitter. Penny stocks are often associated with small, unproven companies. Their price can be highly volatile, swinging wildly from one extreme to another. And this volatility, it carries a high risk of loss. You could buy a stock at one price today, and tomorrow it could plunge significantly. And then there's the issue of liquidity. Selling penny stocks isn't as straightforward as you might think. It can be challenging to find a buyer when you're ready to sell, especially if the stock's price has plummeted. So, while the potential for high returns is there, so too are the risks and challenges. That's why the wealthy often steer clear of penny stocks. Art and collectibles without expert guidance. High risk, potential for loss. Let's dive into the world of art and collectible. It's an intriguing universe, filled with unique pieces that can be worth millions, but it's also a treacherous terrain for the uninitiated. What's the catch, you ask? Well, the value of art and collectibles is subjective and can be incredibly difficult to ascertain without in-depth knowledge and expertise. Imagine purchasing a painting for a hefty sum, only to find out it's worth a fraction of what you paid. That's the risk you run when you venture into this realm without the guidance of an expert. Overpaying is a common pitfall, and it can lead to significant financial loss. But it's not just about avoiding losses, it's about maximizing your gains too. An expert can help you identify undervalued pieces with the potential to appreciate over time. That's why the rich prefer to invest in areas where they have expertise or trusted advisors. Cryptocurrency speculation, high risk, high volatility. Cryptocurrency, a digital or virtual form of currency that uses cryptography for security, has been a hot topic over the past few years. With its soaring prices and the promise of high returns, it has attracted a lot of attention. But it's not all sunshine and rainbows. Cryptocurrencies are notoriously volatile. The value of a cryptocurrency can fluctuate wildly within a matter of hours, making it a highly risky investment. Furthermore, the lack of regulation and oversight in the cryptocurrency market makes it a breeding ground for scams and fraudulent activities. Investors can lose their entire investment overnight with no legal recourse. Additionally, the technology behind cryptocurrencies is still relatively new and unproven, adding another layer of uncertainty to these investments. The rich, on the other hand, prefer investments that offer stability, regulation, and protection. They understand that while high-risk investments can yield high returns, they can also lead to substantial losses. The rich prefer investments with stability, regulation, and protection. Farmland without local knowledge, high risk, potential for loss. Let's talk about why this is. When you invest in farmland, you're not just buying a piece of land. You're stepping into a complex ecosystem with its own unique set of rules and dynamics. Crops, weather patterns, soil quality, pest control, and local market demands. These are just a few of the factors that can make or break a farming investment. Without a deep understanding of these elements, or trusted local advisors who have that knowledge, you're essentially flying blind. It's like trying to navigate a ship through a storm without a compass. The potential for loss is substantial, and the rich, being astute investors, are well aware of this. They know that due diligence isn't just a fancy term, but an absolute necessity. They understand that knowledge is power, especially when it comes to investments. That's why they steer clear of farmland investments where they lack local expertise. Day trading without expertise, high risk, potential for loss. Imagine yourself standing in the midst of a bustling marketplace, with people rushing past in a blur. That's day trading in the financial world. It's a high-speed, high-stakes game where the rules are complex and the players are seasoned. It's not a place for the uninitiated. Day trading involves making quick decisions based on minute fluctuations in the market. It demands a deep understanding of market trends, economic indicators, and financial analysis. Without this expertise, you might as well be playing roulette with your hard-earned money. The risk of loss is significant. In fact, studies suggest that more than 90% of day traders lose money. It's a stark reminder that the stock market is not a get-rich-quick scheme. The wealthy understand this. They know that sustainable wealth is built over time, through careful, informed investing. The rich prefer to invest for the long term rather than gambling on short-term market movements. So, what have we learned? Throughout this journey, one theme has remained constant: the importance of risk management, due diligence, and long-term investing. While the allure of quick profits can be tempting, the rich know that true wealth is built over time, through careful planning, informed decision-making, and consistent action. Remember, the rich don't avoid risk. They manage it. They invest wisely, with a long-term perspective. So if you want to grow your wealth, perhaps it's time to think like the rich. Don't forget to like, subscribe, and hit the notification bell for more content like this.